Welcome back to the Finance Corner, where we have our series going on flipping money slowly. So, this series is all about we're starting with an initial capital, and then we're going to try to flip that money or just increase it, generate some income on it using options contracts, specifically the wheel strategy. So, we're going to be selling options. This is episode two. The first episode, we made a play, we talked about it. Now we got some more sauce to go into. So, anyways, here we have our Robinhood account, our updated account. So we started this account with $7,500, and now we are down to 6,800. But let's talk about why. So basically, yeah, we sold our first play in this account was that we sold a $21 put, and we got paid 95 cents in premium for it. So you combine those two numbers together, that means this 300 shares that we own, we actually own it at $20.05. That is our cost basis for these 300 shares. Now, the next step in the whale strategy is to basically be able to sell covered calls because now we own shares, now we can write covered calls on it. And worst case is we sell those shares at that strike price. Now, I'd love to do this week and do it right now, but the problem is I am not going to be paid any decent amount of premium because if I want to sell a covered call closer to my cost basis, they're not really going to pay me anything because of how far away the current share price is. The current share price is much below where my cost basis is. So basically, to get a more higher premium, we have to kind of wait for coal's price to come back a little bit higher, and then when we when that happens, we be able to collect a higher premium for writing this covered call contract. And essentially, that's kind of where we are now. It's really just like a waiting game. But let's actually review real quick some of the price action that I was looking at as to why I took this trade. But I was also one thing I also pointed out is like what could happen that goes against me, and that exact thing happened, which was price trading back into this zone here. So as you can see, we had a gap from the earnings that was released in November that sent price way higher. I left this gap here, and just based off my years of reading technical analysis and reading price action, um, you know, I was like, I can see it coming back down into this area, right? Because I initially didn't see like hindsight's always 2020, right? It's about being able to, I guess, kind of foresee like what can happen in the future. So this is really what I was looking at by the time I put on that trade, and I was like, it could go higher, but I also thought that like what's more likely to happen is if it goes lower because a tip that I can give all my technical traders out there is like if you're bullish, price probably will go lower before it goes higher. And if you're bearish, price probably will go higher before it goes lower. But anyways, this is a perfect example of that. I'm bullish on this like longer in the mid to longer term, but during the time that we had the trade, just like 2 weeks, we actually had bearish price action. So I highlighted the gap. I was like, I can see it trading down in there, but I got excited. I was like, it's my first trade. We're gonna make content on it. Let's freaking just do it anyway. But that's basically the thought process that I had there, and so we got assigned at the unfavorable price. But what I was gonna say, the more optimal play was to actually write a naked call on it. So we could have wrote a naked call because by the time I was looking at it, price was like up here in 21. What I should have done was wrote a naked call for $20 strike price, same expiration date, and then we would have been able to collect premium on that, and everything would have been happy, and we move on to the next trade. But excuse me, you know, my thought process was like to start the wheel, you need to sell a put first. Um, that's kind of this my thought process. But the goal with this account really is to just be just to flip the money. It's like, you don't have to go in the chronological wheel order. Like, I really should have just considered selling the naked call and collecting the premium with that. But you know, things happen. Things happen. But honestly, another way I can look at it is like, it's probably good. Like, I probably saved myself by not writing the covered call or the naked call because, you know, if so, just basic overview or understanding of calls and puts. When you sell a put, you kind of want the price to go up from that point. You want price to be higher than your strike price when it's by the time expiration date. When you sell a put, when you sell a call, you kind of want the strike price, or you want the share price to be underlying or underneath your strike price. Sorry, it's a whole bunch of definitions. We'll get used to them. But when you're selling a call, you want the underlying share price to be under your strike price. That way, that a call expires out the money, and I would have been able to keep that premium. But one thing about calls is that it actually is very short squeezable. So you can actually see the short squeeze that happened here. This was on a Monday. You see, price started out. Oh no, it was on a Tuesday. Price started out at $10. $10.36 was the close of Monday, and then when price opened, it opened at $9 a share higher. So we closed here at 10.36, 10.40. Then price opened at $19. So that's a short squeeze that, if you were sold a call, and let's say your strike price was like $11, $12, it's like, yeah, you got it's a lot of money you can lose. That's a lot of money you can lose. So, basically, just say that to say it was probably, well, hindsight's always 2020, right? We didn't get the short squeeze during that time frame, but it could have happened, and so it's a good thing that we didn't do that. The worst thing that happened was that we got assigned the shares at $21, but $21 minus premium, which for me is $20.05. So that's really where we're at. And now the goal with the strategy is to write covered calls, because now that we got assigned, we own the shares. Now we just write covered calls and get paid for those premiums until it gets called away from us, and then just keep doing that. But I have to. I think I'll show a screenshot in the options chain. Like, if I was to write because today is the January 25th, on Sunday, so the market's gonna open tomorrow, the 26th, and based on the options chain, like, it's not paying me any premium to write covered calls around my call spaces. If I go a week out, 2 weeks out, it's not paying me anything. So I have to look at maybe 3 weeks out, 4 weeks out, if I wanted to write a contract like tomorrow or this week. So I'm actually gonna hold on to these shares until I see the price go back a little bit higher, closer to my cost basis, and then we can write some covered calls a week out, 2 weeks out, to be able to collect some premium and and generate some income while we try to get rid of these shares. So that's kind of the play that I'm thinking about doing next. We also have earnings coming up on the Tuesday of March 3rd. So anytime a stock gets very volatile around its earnings, and same thing with the options. So another play I'm thinking about is, again, waiting until we get price a little bit higher, but I want to write a contract or write a covered call until maybe like the 25th, or that Friday expiration date, which is the 27th, and then try to collect the premium that way, because those contracts will have a higher premium because it's an earnings play. You know, more implied volatility on a option means a higher premium on that option, and I don't mind being the person to sell people that lottery ticket, which is essentially what you're doing as an option seller. Like, Option sellers are people who sell lottery tickets and people who sell insurance premiums. You know, like if we're looking at somebody on the other end of the trade, I'm selling a covered call or I'm selling a call, they're going to be buying a call, right? So if I sell a call at $21, that means whoever owns that has the right to buy at $21. You know, so if price is what they want is for price to be way higher than $21 so that they can collect the difference. But this is kind of like more so, I mean, you're definitely gambling. My goal as an option seller is I want to sell those gamblers these lottery tickets. So that's kind of the thought process there. And that's kind of where we are with this account. So we got the 300 shares. I'm just going to be waiting for price to come back up a little bit to actually get paid something to sell around my cost basis. So right now we're currently down, but it's all good because I do not mind holding calls. We did miss the ex-dividend date. I think it was on but that was before we even made the contract or wrote the contract. Ex-dividend date was on Wednesday, December 10th. So the next kind of event we got going on with Coles is the earnings around March. So for now, it's just about seeing how the price action goes. Anytime we get closer to my strike or my cost basis, we will start selling covered calls, and then I want to be preparing myself for this earnings play. And that's pretty much the update that we have for this account. Thanks for watching, and see you guys on the next one.